Welcome to the Money Tree Investing Podcast, where we learn from real estate professionals across the industry. They will share about how they got into real estate, the big wins they have celebrated, the mistakes they have made along the way, and the advice they have for anyone following in their footsteps. Money really does grow on trees. Hey everybody, today I've got a friend here from Dallas, Sandhya. I'll let her introduce herself, and if you would, just tell us a little bit about how you got started in real estate and your portfolio and all that good stuff.
I'm Sandhya Seshadri. Thank you so much for having me on your podcast. I'm based in Dallas. I've lived here for over 32 years. Like most Asian geeks, I came here and I did engineering in college and got a corporate job in the engineering world. Realized pretty quick that the management types make all the decisions. So I got a part-time MBA while working full-time there. And from that, I went into the stock market completely full-time once I had children, quit the corporate world. Became almost like a day trader, traded for a few hours every day and made all the money I needed, and then looked for a way for a tax advantage. And that's what brought me to real estate. Did not have a background to do like handyman fix and flips kind of stuff. Did not see the margins in single family. So I went straight into multifamily after attending a weekend program, invested passively with my retirement money that I had left over from my previous job. So that was an easy way for me to network and learn from other people. I think that's one of the biggest benefits of passive investing that people don't realize. They think, oh, it looks easy. Let me just go be an active investor. And people don't realize all the risks that are taken on by general partners. So for me to get an understanding without taking on all the risks, passive investment was definitely the way to get started. So I invested passively in 23 different syndications to date. I still learn a lot when I invest passively. It's a great way to establish a relationship. But then I also, in parallel, now that I invested passively and I learned a few things, I knew what I liked to do when I take on my own active role. And since I was part of a larger mentoring program, I found experienced partners to partner with to get my first syndication. Right now, I'm a general partner in about 1,200 doors. I've had 2 of those go full cycle. So you could add another 360 doors or so. So a total of about 1,500 to 1,600 doors. And 1,200 still actively that I asset manage. So being the local one in Dallas where all the deals are happening, I find the brokers. I have about 4 brokers actually living in my neighborhood. So I find deals, and being an engineer, I love to underwrite. I love spreadsheets. I also, like everybody else, have to do my part in raising the capital. But then I'm especially strong in asset management. I have strong project management skills, and I like visiting my properties, and they're all within like a 30-minute drive of my house. So it makes it easy for me to, pick my 2 or 3 days a week when I visit my properties, and the rest of the time I, do the other stuff that goes on with a syndication. So that's where I am right now in my journey. Love it.
That's awesome. Yeah, no, I'm super excited for you as well. It sounds like you have a lot of good stuff going on. What's some advice you have for passive investors? So especially somebody just starting out trying to get involved in investing in real estate.
I have a strong background in the stock market too, right? So that's why I say everybody is an automatic investor in the stock market just because that's what your dad did, your grandpa did. They all did it with their W-2 jobs, or that's what you do automatically without even thinking about it. But then I see a lot of people hesitate when it comes to real estate. And I'm like, passive investing in a larger syndication is like the best of both worlds. It gets you to dip your feet into real estate, actually own a property, but without having to do all the grunt work for it. So understand it, really get your education in place, because just like with anything, whether it's a stock or a mutual fund or gold and silver and any other commodity you want to trade or real estate, it all starts with education. So get educated, give yourself a deadline, don't just drift and see a year from today not even having done anything. So to put yourself on a time limit, within the next 30 days, I'm going to gather all the information I need about this type of investment so I can make an informed decision. So if it's August now, by September, you should know what you're doing and make a decision on whether or not this is the right investment for you. Understand the risks and the rewards. If you look at history, you look at any kind of historical data, 19th century, 18th century, 20th century, and 21st century, and so on, you will see that the stock market has only performed up to a certain extent unless you're a super active trader, really know your stocks and play the market. Compared to real estate, again, you just do a buy and hold strategy, whether it's a stock market or it's real estate, you'll see that your real estate comes out ahead 9 out of 10 times, because 90% of the millionaires in the world do so because of real estate. So do your homework, give yourself a time limit, and then take action. Take action with at least a small percentage of your portfolio. If it's 100% of the stock market, you could very well diversify and take a small portion and put it into something like real estate in a multifamily syndication with someone who you know, like, and trust in a location that you know is great. So what's a great location? Something that has tailwinds when it comes to market. So job growth, population growth, greater demand than supply, landlord-friendly states, which we pick certain markets along the Sun Belt for that. So Atlanta, Phoenix, Texas, Dallas, of course, is my top favorite because this is where I am. This is where I do everything. Florida, there's the Carolinas, there's Tennessee. So there's a few markets that are doing extremely well and thriving in real estate, where 5 years from today, no matter what that building is, it's probably going to be worth more in 5 years compared to your money sitting in the bank, is losing money, right? You know where inflation's at. They claim it's only 9%. I think it's more like 20%, right? You look at the prices, how much they've gone up. So look at inflation, look at your money sitting in the bank, look at your stock portfolio from January 1st, 2022 to August of 2022. See where that's done. And you're like, really? Come on. You could take a piece of that and put it into real estate instead in the right markets with the right sponsors. You're going to build your wealth much faster that way. The average return of the stock market over a 7-year period is the closest that you'd come to doubling, if that. Real estate, most of the investments, you double your money in about 5 years. And that's, again, a projection. You've got to do your homework, consult with all the experts you want. But remember this, if you're going to be talking to your financial planner, ask them how much experience they actually have in real estate, right? So take advice from somebody who's done it before. Don't take advice from somebody who doesn't know anything about it. I mean, are you going to go talk to a really overweight, obese person about personal training and becoming an athlete, right? So go train with somebody or get your advice from somebody who's either done it before or has the experience or has invested passively, as an example, or owns properties and can see the benefits of real estate. Otherwise, you just talk to somebody who has no idea about real estate. What are they going to say? Oh, don't do it, because it's the fear of the unknown that we all have. Just like, taking that first step is hard. But once you do it, at least in the right markets, you probably won't regret it.
Definitely. Yes, ma'am. And so I think we've talked before, and I'll let you know. So I studied mechanical engineering at Texas A&M. So I'm right there with you. I love the underwriting. I love the analyses. And so you said several things that I really like. So one thing that you mentioned is a mentor. So who's been your mentor, if you don't mind sharing that?
Oh, I'd love to share that. I have so many mentors, but the first and primary mentor who taught me everything I know about multifamily is through Brad Sumrock's mentoring program. He's based in Dallas. He's very well established here. So it's great to be under his umbrella because I can network with so many operators running properties here. But I also have James Kandasamy. I have Hunter Thompson. There are so many other mentors out there. I learn a lot from listening to podcasts and books by many other gurus as well. So, and then within Brad's program, we have so many coaches that I learned from. So I learned from my peers, I learned from experts in the industry, and, I learned so much from my syndication attorney. I learned so much from my accountant. So, it's one of those things that you wrap everything around. But if you're looking for a strong mentoring program, depending on your markets, some are definitely have a certain, shall we say, an advantage in certain markets. And so it helps to network with brokers and be known. So you quickly get the deal.
Definitely. That's really cool. And so I'm actually in construction management currently. And, it's really cool to see how Dallas is just booming. I mean, we have people from California and New York, like everybody wants to move to Dallas. And like you said, we're building apartments all the time and we can't build enough to fill everything. So, I mean, the market rents are just going to keep going up here in Dallas. And it's really cool to be a part of that.
Yeah, it's phenomenal. So the properties that I currently own and manage, we have waiting lists in some properties. We're almost always very, very full, which is a sign that you could increase the rent and nobody objects to it, because we had a couple of tenants really protest because they had stayed at our property for a while. They tried to shop around. They came back and said, oh my gosh, the other property is not even half as good and they want more than what you want, kind of thing. So it's a supply and demand situation, really simple. So definitely look for that in markets because, in real estate, everything is about the location, right? So you got to get the location right because that's half the battle. The location and the deal has to be right. And then your jockey or your sponsorship team is one of the most important things. Do they have experience in that market? Or are they sitting in Canada and California trying to remote control a deal out in Florida, right? That's what you want to really know. Who's boots on the ground with the local knowledge? Does a property management company they employ have local knowledge? Those are the questions you should be asking as an investor, right? What knowledge do they have? And imagine this situation, right? Let's say you're going to hire a contractor to do a $50,000 kitchen remodel in your house. What's the first question you're going to ask them, right? You're going to ask them for references. You're going to say,
Have you done this before?
Have you done this before? And who did you do it for? And let me talk to them about what really happened. So same thing. Before you invest your money, ask them, you've done it before. Give me some examples of your deals. Share with me the couple of passive investors from those deals. Let me go talk to them. Then I know the true story. Because if you just want to, ask the investor, the sponsor themselves about the deal, they may not always tell you all the things that went wrong. Or they may not tell you that, hey, we had to suspend distributions for a while because of COVID, right? So you want to get the real truth, ask for true references, which is past passive investors from all their deals, not just their best deals.
Definitely. Passive investors in real estate are able to receive a check every month. Some people call that mailbox money. We say money really does grow on trees. Visit the website at biggerpictureholdings.com, where we have a ton of free resources to help you learn more about planting your very own money tree. So I had just a few more questions for you. So obviously, it looks pretty scary out there in the economy. We're seeing the GDP go down for two consecutive quarters, maybe signs of a recession. So what are some ways that you are conservatively underwriting and some things that you're kind of changing and shifting towards to be a little more safe in these times of investment?
So we've always underwritten deals in a very conservative manner, in the sense that, you assume a worse time in 5 years when you plan to sell your deal. So we do that by assuming what we call an exit cap. So the cap rate at the time that I'm going to sell this property is going to be much higher, which means the market is much worse when I'm going to sell the property than today when I'm buying the property. So that's one way to conservatively underwrite. The second one is all your rent bumps. Don't make them to be huge rent bumps unless the median household income can support it and you've actually visited and properly shopped the comps nearby. Comps meaning similar, competitive properties nearby that a resident could go stay at instead of your subject property. Do they have similar amenities? Are they a similar vintage? So if a brand new, nice, fancy looking A-class property gets built nearby and they're charging $400 more for rent compared to your old 60s chiller property, well, that's not a fair comparison. So It's got to be a fair comparison within a 1 mile radius on the same side of the highway with a median household income that can support your highest rent bump. So if your monthly rent is $1,500 times 12, you're at $18,000. Times 3 makes it a $54,000 median household income that is needed to support that rent. So if the median income there is only $36,000 and this person is assuming a 15% rent bump, okay, that's not realistic, right? So that's what I mean by conservative underwriting. Every line item, every expense that you have in your underwriting has to be validated by a professional in that industry. So if you're assuming a certain increase in your taxes, make sure your tax protest company agrees to that number. Like in Texas, the taxes make a huge difference. Phoenix, not so much. Insurance, right? How much are insurance rates going up every year? You want an insurance company to tell you that number. And that's what you want to put in there in your Excel spreadsheet for underwriting. You want to make sure a property management company who runs properties in that area is giving you budget numbers that are realistic, that they can definitely meet. And that's what you put into your underwriting, whether it's a rent increase, whether it's a source of other income, whether it's personnel, payroll, all the other expenses, admin, et cetera, that go with it, your marketing budget. If your occupancy is particularly low, you might have to pump some money into your marketing efforts to increase that. So whatever is the business plan you have in mind for this property, somebody should agree with you. The person who's going to run your property for you, right? That property management company has to agree to that plan. So that's an important way. The other way that you conservatively underwrite in today's market is we stopped doing any bridge debt for the present time. So the deal that we closed last week, the deal that we're under a contract for, all of them are going with fixed rate agency loans, but with a step down prepay so that we don't have a huge yield maintenance penalty at the end. So the reason an agency debt deal is much more conservative is because agencies underwrite your deals based on the past T12, trailing 12 months of performance. That means you must already be stabilized and be able to support your mortgage payment, financial obligations with your current rents without ever having to increase rent. So if you're qualified for a Fannie or a Freddie loan, that means you're a stabilized property doing well already. So that's another way that we make sure our deals are conservative, because if you are under contract for a bridge debt, the question is, what is going to be the interest rates at the time that you close? It may be 60 days from now that you're going to close that bridge loan. You will not know the actual interest rate, the loan proceeds, or the cost of your rate cap until a few days before closing. So what if there is a big gap there, right? What if the interest rates go up? So therefore your loan proceeds are reduced because of it, and you have to come up with $1 million last minute. Okay, let's just say somehow you're able to magically come up with that $1 million last minute. Well, if your raise therefore is $1 million more, then your returns to investors would be reduced because just now you increased your amount in your raise, right? So you got to factor all these things in. And that's why with a fixed rate interest with Fannie or Freddie, that you can lock in the rates, then your proceeds are also fixed, regardless of what happens because of all the politics and noise and everything else that's happening around the world. So yeah, I could probably go on a little bit longer, but that's pretty much a high level summary, I would say, of why or what makes up a conservative underwriting.
No, that's super helpful, and it's really cool that you have been doing deals and you're still doing deals in this time frame. I think some people are kind of paused and a little hesitant and maybe even afraid. But like you said, I mean, with the right underwriting, the right team, there's still really good deals to be had, and there probably will still be, even if things continue to get worse economically.
I think there's some great deals to be had because compared to January 1st of 2002, I can get deals priced today 10 to 15% less, if not a greater discount. And as the interest rate increase and therefore the mortgage payment on your bridge loan increases every month, a lot of deals are getting a little bit squeezed because maybe they were hoping to refi this year, but the timing didn't work, right? So that's another thing. I do not include any refi in my underwriting. It's sort of like a bonus. So let's say 2 to 3 years from now, the interest rates are great. I'm able to refi. That's awesome. But if I'm not able to refi, I may have to just hold it, right? Or sell it. So there's a lot of people today who might be forced to sell because they aren't able to do the refi they were hoping for. So then we might be getting a good discount. So it's almost like when the market crashes, it might be a good time to buy stocks, right? It's just that same philosophy. Right now, prices are going down in real estate, and real estate is illiquid and a long-term hold anyway. We always tell our investors it's a 5-year hold period or longer. So you want to definitely make sure you have money that you invest. You're not planning to get it anytime soon. It's going to be a 5-year hold. And if you think about it that way, and the price today is lower by about 10 to 15% than what you might have paid for the same asset 6 months ago, I mean, I call that a discount. I call that a bargain because it's still the same property. All you got to do is take it and operate it more efficiently and be careful with your spending. And in 5 years, it's going to be worth more, right? Provided you picked it in the right markets. Low crime, high median household income, tailwinds.
Definitely. That's really cool. So to kind of wrap things up, so you've been going around doing a lot of seminars, a lot of conferences. What have been some of your favorites so far, and who have been some of the coolest people that you've met?
Well, there's always celebrities. So I went to Charlotte for Multifamily Investor Nation conference, as well as the Invest Her conference. And in both of them, I met some great celebrities. I read Barbara Corcoran from Shark Tank at MFIN, and I met Kim Kiyosaki, Robert Kiyosaki's wife at
that's cool.
Invest Her, right? And I've got all these pictures and selfies with both of them, which is kind of cool. So I think that's really cool. I also like a lot of regular people I meet on at conferences, right? So great investors, a lot of the gurus I meet, like Rod Cleave, Michael Blanc, Whitney Sewell, Dan Hanford. They're all, my little icons in the multifamily space, and it's wonderful to meet them. Liz Faircloth, Andressa, there's just Kathy Fetke. There's so many different people being so successful in this multifamily space that it's wonderful to go to these conferences and network with them, meet them, see how they feel. So I was actually on a panel where we talked about the economy, and it was surprising to see how many people were still so bullish on real estate. And if anything, I think in a recession time, real estate really comes out ahead. So when the world stopped for COVID and all of us shut down and we had to hunker down at home, guess what? My apartment investments did great. That's the time that I made the most money, 2020, 2021. I mean, I made more money in apartments than any other investment during that time period. So it's been fantastic.
That's awesome. Well, thank you so much for joining us today, and hopefully we can have you on again sometime.
That sounds awesome. And you can find me on LinkedIn if you want to get a hold of me. Thank you for the opportunity.
Thank you so much. Like and subscribe below. A new episode will air every Tuesday at 7 a.m. Are you looking for more content? Visit our website, biggerpictureholdings.com. And remember, money really does grow on trees.